Okay, welcome to the deep dive. Today we are taking a deep dive into the absolute fundamentals, the bedrock, really, of stock market investing. This is specifically for you if you're just starting out, the beginner investor, the
Yeah.
herd, as they say.
That's right. We've been looking at this pretty comprehensive guide. It's really aimed at walking someone with zero experience through the core concepts they absolutely have to get their head around before they even think about placing a trade.
Yeah, and our mission here, what we're trying to do is unpack those two sort of basic operations you hear about straight away, doing long and doing short.
Hmm.
We need to figure out what they actually are, highlight the really crucial differences, and then pull out all the practical advice from this material on getting ready, handling risk, and super important, getting the right mindset.
Yeah, the mental game.
Think of this as your shortcut, basically, getting you grounded in the essentials without, hopefully, getting totally overwhelmed.
It's about laying that foundation.
Yeah.
You really can't skip it.
Right. So let's just dive in. At its absolute core, if you're going to be in the stock market, there are really two main bets you can make on which way a price is going to go. It all boils down to these two things, doing long and doing short.
Exactly. They're the two fundamental ways you position yourself based on what you think an asset's price is going to do.
Okay, let's start with the one that I guess feels more intuitive, the one that kind of mirrors how basic business works. Doing long or tech, what's the main idea there?
Doing long is, yeah, it's the classic way. Most people think of this first. It just means you buy something like a stock because you think its price is going to go up. Simple as that.
Right.
The plan is buy it lower, sell it higher later, make some money.
The classic buy low, sell high. Okay, makes total sense.
Exactly. You're taking a bullish view, or as the guide puts it, keck. You think things are looking up for the market or that specific stock.
And the source mentioned it's not just clicking buy, right? There's a bit more to the doing long idea.
Yeah, there's a slight nuance. I mean, the action is buying, sure. But doing long really implies you're holding that stock because you expect it to rise.
Yeah.
You've got a long position. You might buy for other reasons, maybe dividends or something, but being long means you're betting on the price going up.
Got it. Okay. Now, the guide says this is the natural place for beginners to start. It makes sense intuitively, but why else is it the recommended first step?
Well, the main reason, and this is absolutely critical when you're starting, is the risk. It's about how much you can lose.
Okay.
When you buy a stock, the absolute maximum you can possibly lose is the money you put in. That's it. If the price goes all the way down to zero, which, is the floor, you lose your initial investment. But crucially, you can't lose more than that.
Okay, so your potential loss is known upfront. It's limited. That feels, well, safer.
Yeah, significantly safer than the alternative we'll get to.
Yeah.
And the guide also mentions, the bigger picture. Historically, over the long haul, major world markets have generally trended upwards.
Right. There's that general drift up over decades.
Exactly. Now, that doesn't guarantee your stock will go up or that there won't be crashes, obviously. But for a beginner looking long term, that historical tendency is kind of a helpful backdrop for long strategies.
So the process itself is pretty straightforward then. Buy the stock, hold on to it, sell it later when, fingers crossed, it's higher.
That's pretty much it. You buy shares through your broker, you hold them. Could be minutes, could be years, depending on your plan. And then you sell when you decide to close the position.
Let's use the example from the guide. Say I buy 100 shares at 10 each. That costs me $1,000.
Right. If the price goes up to 12 and you sell, you get $1,200 back. So your gross profit there is $2,000 before any fees, of course.
And if it goes the other way, say it drops to 8.
And you sell, you get $800 back. You've lost $2,000 on that trade. And if somehow the company went bankrupt and the stock went to zero, your maximum loss is capped at that initial $100 you invested. That's the limit.
Okay, max loss is clear. But, and this is where it gets interesting, even with this simpler long approach, there are still risks, right? It's not like it's risk-free just because the loss is capped.
Oh, absolutely not. No way. The main risk, the most obvious one, is just that the price goes down after you buy. Simple as that. Your investment loses value.
Right, the market moves against you. What else should a beginner be aware of?
Well, there's opportunity costs. That's kind of the hidden cost. Your money is tied up in that stock. If it's just sitting there, or worse, going down, that capital isn't working for you. It could have been in something else that was growing.
The what-if cost.
Exactly. And then you've got risks specific to the company itself. Even if the whole market is doing okay, the particular company you picked might hit trouble. Bad earnings, a scandal, management changes, product fails. Stuff like that can sink a stock price regardless of the overall market.
The source also mentioned a specific risk with something called a long grid strategy. What's that
Yeah.
about?
Oh yeah, that's more for automated trading. If you use a strategy like a long grid, which automatically buys more shares as the price falls to average down your cost, well, if the market just keeps sliding down steadily without bouncing much,
Uh-oh.
you can end up buying more and more at lower prices, but your average cost might still be pretty high compared to where the price is now. You end up holding a lot of shares underwater, tying up a lot of capital, waiting for recovery that might take a long time or might not come.
So even the straightforward long has potential pitfalls. Okay, let's take a deep breath and look at the other side of the coin. Doing short or charm? This one definitely feels less natural.
It is, yeah. It's counterintuitive for most people because you're essentially betting on a price going down. And how you do it is completely different from just buying. The idea is you think a stock's price is going to fall, so you want to somehow sell it now while it's high and then buy it back later when it's cheaper.
Wait, sell something I don't actually own? How does that even work?
That's the key difference. You don't own it first. The way it works is you borrow the shares, usually from your broker.
Borrow stock.
Yep, borrow the shares. Then you immediately sell those borrowed shares on the market at the current price. You get the cash. Then you wait, hoping the price drops. If it does, you buy the same number of shares back at the new, lower price, give those shares back to the broker you borrowed them from, and the difference in price is your potential profit.
Okay, borrow, sell high, hope it drops, buy low, return. That sounds way more complicated than just buying.
It absolutely is. It needs a special kind of brokerage account, usually a margin account, and it involves specific processes like show or show, which means stock borrowing.
Okay, walk me through the steps again, like the guide laid out.
Sure. First, you find a stock you're bearish on, you think it's going down, you tell your broker you want to short sell it. They check if they actually have shares of that stock available to lend out.
Right, they might not have any to lend.
Exactly. But if they do, you borrow, say, 100 shares. As soon as you borrow them, you sell them on the market. Let's say you sell them at $50 a share. That $5,000 cash goes into your account, but it's marked because you owe those shares back.
Yeah.
Then you wait.
And if the price does fall, say to $40?
Perfect scenario for the short seller. You then buy back 100 shares on the market for $40 each, which costs you $4,000. This is called or covering your short. You immediately return those 100 shares you just bought to your broker. Your gross profit is the $5,000 you got initially minus the $4,000 you spent to buy them back. So $1,000 profit minus borrowing costs and fees.
Okay, the profit side makes sense if it works out, but what if the price goes up, say it goes to $60 instead of down?
Now here's where the risk profile gets completely different and frankly much scarier. If you have to buy back those 100 shares at $60 to return them, that's going to cost you $6,000.
But I only got $5,000 when I sold them initially.
Precisely. So you received $5,000, but you had to spend $6,000 to close the position. That's a $1,000 loss.
Okay, so what does this mean for the overall risk? The guide really emphasizes the dangers of shorting, and they sound fundamentally worse than going long.
This is the most critical takeaway, especially for beginners, and the guide is emphatic. Short selling is categorically different and way riskier. The absolute biggest, most terrifying risk is what they call chasha on theoretically infinite loss.
Hold on, infinite loss. How is that possible? When I go long, the lowest price is zero, so my loss is capped at what I paid.
Exactly. But think about it. How high can a stock price go?
Well, theoretically, there's no limit.
Right, there's no ceiling. If you short it at $50 and the price goes to $100, $200, $500, your loss per share just keeps growing and growing. For every dollar it rises above your entry point, you lose that dollar per share when you eventually have to buy it back. Mathematically, your potential loss is unlimited.
Okay, wow. Even if truly infinite doesn't happen often, the potential for massive uncapped losses is, yeah, that's scary. Does this unlimited risk lead to specific problems in the market?
It sure does. And one of the most dangerous is the heis, or short squeeze. This can be absolutely brutal for short sellers.
What happens in a short squeeze?
It's when a stock that a lot of people have shorted, everyone's betting it will fall, suddenly starts shooting up rapidly. Maybe there's surprise good news, or maybe just a coordinated buying effort. As the price rockets up, all those short sellers are looking at huge losses.
Because their potential loss is growing fast.
Exactly. And margin calls start hitting. We'll get to that. So they get desperate. They're forced to buy shares to close out their losing position and stop the bleeding. But all this concentrated buying from panicked short sellers just pushes the price up even faster.
Oh, wow. A feedback loop.
A vicious feedback loop. More shorts get squeezed, they're forced to buy, driving the price higher still. It can cause catastrophic, rapid price spikes that just obliterate short positions in hours or days.
That sounds like a nightmare scenario.
It is. And remember, shorting usually requires a margin account. So as the stock price rises against you, the equity in your account shrinks relative to the value of the shares you owe. If it drops below a certain maintenance level set by the broker,
They come calling.
they issue a HODJ, a margin call. They demand you deposit more cash right now to bring your account equity back up. If you can't or don't, they have the right to forcibly close your position. They'll buy back the shares for you at the current, likely very high, market price, locking in your huge loss. They can even sell other assets in your account to cover it.
So even if you think the stock will eventually fall, you can be forced out at the worst possible time because of margin rules.
Exactly. You lose control. Plus, there are other costs and hassles. You have to pay interest or fees just for borrowing the shares in the first place. That eats away at profits day by day.
Right, borrowing isn't free.
And sometimes, the stock you want to short might be really hard to borrow. Or the available shares are limited because so many people want to short it. That can make the strategy impossible or super expensive.
The guide even mentioned regulatory risks, like governments stepping in.
Yeah, that's another thing. Sometimes, usually during big market panics, regulators might step in and temporarily ban or restrict short selling on certain stocks, or even the whole market. They worry it makes declines worse. The guide notes this happened centuries ago in England, but it's happened in modern times too. If that happens, you might be forced to close your short position when you don't want to.
Okay, what if the company pays a dividend while I'm shorting it? While I've borrowed the shares?
Good question. You have to pay the dividend amount to the person or entity you borrowed the shares from. It's another cost to factor in.
And something about being forced to buy back, Shina.
Yeah, sometimes the original lender needs their shares back, maybe for voting at a shareholder meeting or something. They could recall the shares, forcing you to go into the market and buy them back to return them, again, possibly at a really bad time for you, price-wise.
Okay, let's recap the shorting risks. Theoretically infinite loss, terrifying short squeezes, margin calls forcing you out, borrowing costs and availability issues, potential government bans, paying dividends, maybe being forced to buy back. This is just, wow, it's a minefield compared to going long.
It really is.
So given all that, the source seems incredibly clear on this, right? Is short selling something a beginner should even consider?
Not just clear, the source is absolutely definitive on this, and it matches what basically every credible expert says. No. Short selling is not for beginners. It is universally advised against, strongly.
Why is such a hard line?
Well, look at everything we just discussed. It's mechanically complicated. The risks are just astronomically higher, especially that unlimited loss potential and succeeding requires incredibly precise timing, really deep analysis, and just rock-solid, almost unemotional risk control and discipline.
Skills that beginners just don't have yet.
Exactly. These are things that take years, maybe decades of experience to even begin to master. And the guide makes a really common sense point. If you haven't figured out how to consistently make money doing the simpler thing going long where your risk is capped.
Then how on earth could you possibly succeed at shorting?
Right. Shorting adds so many layers of difficulty, cost, and catastrophic risk. You can lose your entire account, or worse, end up owing money far, far faster than you ever could with a simple long position. Trying to short before mastering long is like trying to juggle chainsaws before you can juggle tennis balls. Don't do it.
Okay, the message is loud and clear. The contrast is really stark. To make sure everyone gets it, let's quickly run through those key differences side by side, like the guide summarized.
Yeah, laying them out really highlights how different these two beats are.
Okay, first, the basic bet. Expected market direction. Long is betting on up. Short is betting on down.
Order of operations. Long is buy first, then sell later. Short is borrow and sell first, then buy back later to return. Totally different flow.
How you profit. Long makes money if the price goes up. Short makes money if the price goes down.
Maximum profit potential. For long, it's theoretically unlimited because the stock price can keep rising. For short, your maximum profit is actually limited. It happens if the stock goes to zero, you profit the initial price you sold at.
And the absolute crucial one, maximum loss. For long, it's limited to whatever you initially invested. For short, It is.
Theoretically unlimited. That asymmetric risk is the killer difference.
Main risks we worry about. For long, it's the market falling after you buy, opportunity cost, maybe bad news about your specific company. For short, it's the price rising, the dreaded short squeeze, getting margin calls, issues borrowing the stock, regulatory changes, paying dividends, being forced to cover. It's a longer list.
Definitely a longer and scarier list.
And finally, who is it for? Long is for pretty much all general investors, and especially recommended for beginners. Short is really only for very experienced investors, people with a high tolerance for risk, deep pockets, and specialized skills.
Yeah, this comparison just slams the point home. Shorting isn't just long and reverse. It's a whole different, much more dangerous game, particularly if you're new.
Right, so now you understand the difference between long and short, and you're absolutely clear that shorting is off the table for beginners. Fantastic. But as this guide really stresses, knowing that is just step zero. There's a whole essential curriculum, things you must learn and prepare before you even make that first buy order. This is like your driver's ed, your safety gear.
Yeah, think of long versus short as knowing which pedal is gas and which is brake.
Hmm.
But you still need to learn the rules of the road, how to read signs, how to actually navigate, check your mirrors, maintain the car, all that stuff before you drive alone on the highway.
Okay, so step one in this beginner's essential course the guide talks about. Building your knowledge foundation. Because knowledge is power, right? For a beginner, where do you even start? It seems like so much.
You start with the real basics, like how do prices even move?
Mhm.
It boils down to supply and demand. More people wanting to buy than sell pushes the price up. More wanting to sell than buy pushes it down. So you start to ask, okay, what affects that supply and demand? Things like how well the company is doing, what's happening in the wider economy, overall investor mood or sentiment, even politics or global events.
And learning the actual language, right? All
Yeah.
the terms and jargon.
Oh, yeah, absolutely. You have to learn the lingo or you'll be lost. Basic stuff like the difference between market order, buy or sell right now at the best price available, and a limit order. Only buy or sell if you get your specific price or better. Understanding trading units, how many shares are in a standard lot or L, knowing when the market is open, getting familiar with looking at a basic price chart, maybe understanding what K-lines or candlesticks and moving averages are trying to show you. It's like learning vocabulary for a new language.
Okay, get the basics, learn the terms. Then the guide mentions learning to read charts and, importantly, financial reports. How does a beginner even approach that without their eyes glazing over?
Uh-huh. Yeah, it can seem daunting. This is where you start to figure out why you might pick one stock over another. Reading charts is part of what they call technical analysis.
Okay.
You're looking at the stock's past price movements and how much trading volume there was, trying to spot patterns or trends that might hint at where the price could go next. It's kind of based on the idea that history and market psychology tend to repeat themselves sometimes.
Looking for clues in the graph's history. Got it. What about the other type, fundamental analysis? That sounds heavier.
Fundamental analysis is more about digging into the company's actual underlying business and its real value. You look at the big picture of the economy, the industry it's in, but mostly you focus on the company itself. What's its business model? Are its products any good? Who's running the company? And crucially, what do its financials look like?
Ah, yes, the financial statements. Income statement, balance sheet, cash flow statement, just the name sound, homeworky.
They can, but let's try to make them less scary. A guide points to these three because they tell you the really important stuff about a company's health. Think of the income statement, like the company's report card for a period, say, the last quarter or the last year.
Okay, a report card.
It shows how much money they brought in, revenue, what it cost them to make that money, and what was left over as profit, net profit at the end. You'd look at things like gross margin, how profitable each sale is, and EPS, earnings per share, which is kind of the profit allocated to each single share of stock.
Report card for the period. Got it. What about the balance sheet?
The balance sheet is different. It's like a snapshot photo of the company's financial position on one specific day, like December 31st.
Snapshot. Okay.
It shows everything the company owns. Assets like cash, buildings, inventory, everything it owes to others. Liabilities like loans, bills to pay, and what's left over, which belongs to the owners or shareholders, equity. There's a basic equation. Assets always equal liabilities plus equity. Think of it like your own personal net worth. What you own minus what you owe. The balance sheet is the company's version of that snapshot.
Okay, financial photo on a specific date. Makes sense. And the last one, the cash flow statement.
This one's super important. Sometimes beginners overlook it. It tracks the actual cash moving in and out of the company over a period. Not just accounting profit, but real money.
Like a bank statement.
Kinda, yeah. It shows where cash came from and where it went. Usually broken down into cash from running the main business, operations, cash from buying or selling long-term assets, investing, and cash from borrowing or paying back debt, or issuing stock, financing. Why does it matter? Because a company can look profitable on its income statement but still run out of cash if customers aren't paying their bills fast enough or if they're spending tons on new equipment. This statement tells you if they actually have the cash to pay their bills, invest for the future, and maybe pay dividends. It's about liquidity.
Okay, report card, snapshot, and the company's checking account activity. That helps make them less intimidating. The guide says finding these is usually easy, but understanding them, that's the real challenge.
Totally. You can usually find them right on the company's website under investor relations or on the stock exchange's site or big financial news sites. The skill, which definitely takes time to build, is looking at those numbers and figuring out what they mean for the business and its future. For a beginner, maybe just start by finding key numbers like EPS, gross margin, and how much debt the company has compared to its equity debt ratio. Look at how those numbers are trending over time. Maybe compare them to competitors. You won't be an expert overnight, but you have to start looking.
Right, start building that muscle. Okay, so build a knowledge base. Next up in the guide, making smart choices about your broker and how to even approach picking your first stocks. Anyway, let's talk brokers first. They all seem to advertise cheap fees. Is that the main thing?
Fees matter, definitely. You should compare commission structures per trade, per share, percentage. Are there inactivity fees? But the guide is clear. Cheap isn't everything. It's just one piece.
What else is really important, especially for a beginner, like the platform they use?
Oh, huge. The trading platform, the website, or the app you actually use to place trades and check your account has to be easy to understand and use. Is it intuitive? Does it crash? Does it give you reliable, real-time price data? A confusing or glitchy platform is just asking for costly mistakes, especially when you're new and maybe a bit nervous.
Yeah, you don't want to accidentally buy 1,000 shares instead of 100 because the interface was weird.
Exactly. And the guide strongly recommends using any demo accounts the broker offers. Play around with fake money first. Get comfortable navigating, placing different order types, finding information before you risk a single real dollar.
That sounds like absolutely essential advice. Demo trading first. What else matters in a broker?
Customer service. Can you actually get help if you need it? Is it easy to contact them? Do they offer support in your language if that's important, like if you need you for overseas markets? Also, what can you actually trade there? Do they offer the markets you're interested in, maybe U.S. stocks, Hong Kong stocks, A shares? Do they have ETFs? And while maybe less critical if you're only planning to go long on big stocks initially, it's worth knowing about their stock availability for borrowing, just in case you ever consider more advanced strategies way down the road. Though, again,
Shorting is not for beginners. We got it. But what's the absolute #1 most critical factor when choosing where to put your money?
this one is non-negotiable, according to the guide. Compliance and the safety of your funds. You must use a broker that is properly registered and regulated by a serious, reputable government financial authority. The guide gives examples like the SFC in China or Hong Kong, the SEC in the US, the FCA in the UK, ASIC in Australia. Make sure they're legit and subject to oversight. Avoid shady, unregulated platforms promising crazy returns. Protecting your actual capital from fraud or the broker going bust has to be priority #1.
Okay, find a regulated broker with a good platform and use the demo account first. Got it. Broker chosen.
Yeah.
Now, the $1,000,000 question. How does a beginner even start picking stocks? There are thousands.
Yeah, it's overwhelming. The guide offers some really practical starting points. First, maybe the most important, stick to what you know.
Invest in what you understand.
Exactly. Start with companies or industries whose business you actually kind of get. Maybe it's a consumer brand you buy all the time, a tech gadget you use every day, a store you shop at. It's just much easier to judge the prospects of a business if you understand what it does and who its customers are.
So maybe don't jump into like biotech or complex financial derivatives on day one.
Probably not, no. Then the guide suggests leaning towards bigger, well-established companies. Overjards. Think large caps, companies with long track records, stable earnings, recognizable brands. They tend to be less volatile, less likely to disappear overnight than tiny unknown companies. That offers a bit more stability when you're learning.
Do I need to become a Wall Street analyst overnight to check their financials?
No, not at all. But do a basic check. Learn where to find and understand a few key numbers we mentioned earlier, like the PE ratio, price to earnings, maybe the PB ratio, price to book, if they pay a dividend, what's the dividend yield and how much debt they carry, debt ratio. These give you a very rough first impression of how the market values the company and its basic financial health.
What about that idea of a moat? A moat.
Yeah, the economic moat. That's a term popularized by Warren Buffett. The guide highlights it. It means looking for companies that have some kind of sustainable competitive advantage that protects them from competitors eating away their profits.
Like what kind of advantage?
Could be a super strong brand name everyone trusts, maybe unique technology that's hard to copy, maybe network effects like a social media platform where everyone is already on it, making it hard for a new one to compete, or maybe they're just so big they have significant cost advantages, economies of scale. Companies with these moats tend to be more durable long-term investments.
So look for solid, understandable businesses, maybe big ones, with some kind of edge. What about putting all my money in just one great company? Seems risky.
Very risky. The guide definitely pushes for diversification, even if it's modest to start. Don't put all your investment money into just one or two stocks. Spread it out a bit across several different companies, maybe even in different industries. It's that classic wisdom. Don't put all your eggs in one basket.
Right.
If one investment does badly, it doesn't sink your whole portfolio. And the guide points out a really simple, effective way for beginners to get instant diversification is by buying index ETFs.
Exchange-traded funds, you mentioned those. How do they help diversify?
An index ETF basically buys and holds all, or a representative sample,
Huh.
of the stocks in a specific market index, like the S&P 500 in the US, or maybe a major index in Hong Kong or Shanghai. So with one single ETF purchase, you instantly own tiny pieces of hundreds of different companies. It's diversification made easy.
Okay, ETFs sound like a really good tool for beginners then. Easy diversification.
They really are. And finally, the guide reminds you to make sure your stock choices actually fit your personal situation. What are your goals? Are you investing for retirement far away or something sooner? And how much risk are you truly comfortable taking? Some brokers even try to help by categorizing stocks like speculative, balanced, conservative.
Your choices should match your timeline and your stomach for volatility.
So the beginner's stock picking strategy seems to be start with understandable, maybe large companies. Do a basic financial health check. Look for a competitive edge or moat. Spread your money out a bit. ETFs are great for this. And definitely ignore random hot tips.
Absolutely. Following random tips without doing your own thinking is how you end up being the leak that just gets harvested by the market pros.
Ouch. Okay, speaking of not getting harvested, let's talk about the next crucial part, risk management. The guide calls this your investment seatbelt. Non-negotiable. This is all about protecting your capital, right? It is absolutely fundamental. It's your first line of defense against disaster, and it starts with the most basic thing, managing your funds.
And the golden rule here? The absolute must-do.
Only invest money you can afford to lose. What the guide calls spare money. This cannot be money you need for rent, food, bills, or your emergency fund. You need that separate, like 3-6 months of expenses saved up. It can't be money you need for a big goal in the near future, like a house down payment next year. And the guide is super emphatic on this. Never, ever invest borrowed money, especially not high-interest loans like credit cards or payday loans. That just adds immense pressure and risk.
That seems so obvious, but I bet it's a rule people break when they get caught up in the excitement.
It's a huge mistake people make. Tied into that is controlling your position size. Don't just dump your entire investment fund into one single stock, no matter how much you love it.
Don't go all in.
Right. Set limits. Maybe decide that no single stock will ever be more than, say, 5% or 10% of your total portfolio value. The guide mentions some methods like risking only 1% or 2% of your total capital on any single trade idea. The point is to limit the damage any one bad decision can do.
So if one stock goes terribly wrong, it hurts, but it doesn't wipe you out.
Exactly. It keeps you in the game. Another idea the guide mentions is maybe considering staggered investment. If you like a stock but aren't sure if now is the perfect time, maybe buy a little bit now, a bit more later if it dips, or a bit more if it confirms its upward trend. It averages out your purchase price, reducing the risk of buying everything right at a temporary peak.
Okay, use spare money only, control how much you put in one thing, maybe buy in stages. How about protecting yourself once you're in a trade? The guide talks about setting stop loss and take profit points.
Yeah, these are crucial discipline tools. They're your pre-planned exit strategies. A stop loss is a specific price or maybe a percentage loss that you decide on before you even buy the stock. You make a rule. If this stock drops to X price, I sell. Period.
No matter what, even if you think it'll bounce back.
That's the discipline part. The stop loss is there to cut your losses automatically, preventing a small, manageable loss from turning into a huge, damaging one. Sticking to it, even when it feels painful, is critical.
It's the safety eject button. What about the other side? Take profit.
That's planning for success. It's setting a target price or a target profit percentage where you say, okay, if it reaches this level, I'll sell some or all of my shares and lock in the gains. This helps fight greed, the temptation to hold on forever, hoping for even more, only to watch the price fall back down again.
It forces you to actually realize some profits. This seems connected to thinking about the risk-reward ratio before you even make a trade.
Absolutely. It's a core part of the decision. Before buying, you should ask, okay, where would my stop loss go? How much could I lose on this trade? And where is my realistic take profit target? How much could I potentially gain? You ideally want to find trades where the potential gain is significantly bigger than the potential loss.
Like, aim for trades where you can make maybe 2 or 3 times what you're risking.
Exactly. The guide suggests aiming for something like a 2.1 or 3.1 reward-to-risk ratio, or better. Why? Because nobody wins every trade. But if your winning trades are much bigger than your losing trades, you can be profitable overall even if you only win, say, 40% or 50% of the time.
So plan your exit points for both loss and profit before you enter, and make sure the potential reward justifies the risk. And diversification comes up again here too.
Yep, it's worth hammering home because it's so fundamental to managing risk. Don't put all your eggs in one basket. Spreading your money across different companies, different sectors, maybe eventually different asset types, reduces the chance that one bad investment blows up your entire plan. And again, for beginners, buying a broad market index ETF is a super simple way to get diversification right from the start.
So the big picture for risk management, it's not just about reacting when things go bad. It's about having a proactive plan before you trade, using only spare money, controlling your position size, setting your exit points with stop losses and take profits, thinking about risk reward, and diversifying. It's a whole system.
It's your complete protective framework. Like driving a car, you need the seatbelt, the airbags, the brakes, insurance.
Yeah.
You need all the safety systems working together. Don't invest without your risk management system in place.
Okay, we've covered building knowledge, making smart choices, and rigorous risk management. The final piece the guide really digs into, and honestly, maybe the hardest one, is mindset training. Basically, fighting your own brain. The guide says psychology is just huge in investing.
It really is. Arguably, it's the biggest reason why many beginners and even experienced people lose money. It's often not lack of knowledge, but lack of emotional control.
And the two big emotional culprits are usually greed and fear, right?
The classics. Greed kicks in when prices are going up fast. It makes you feel overly optimistic, maybe chase stocks that have already gone way up, hoping to catch the last bit of the ride, or it makes you hold on to winning stocks way too long, hoping for just a little bit more until the trend reverses and you give back all your gains.
Chasing highs and holding too long? Okay. What about fear?
Fear is the panic reaction when prices start falling. It makes you want to just sell everything. Can it stop the pain? Often this means selling right near the bottom, locking in your losses out of sheer terror, only to watch the market rebound without you.
Selling low because you're scared. Buying high because of FOMO. Common traps.
They happen all the time. The key, the discipline, is learning to stick to your pre-made plan, your analysis, your stop losses, your take profits, and not let the market's daily noise or your own churning stomach make you ditch the plan impulsively.
What about all the noise from other people? The hype, following the crowd, listening to hot tips?
Yeah, the guide warns strongly against that. Beware of herd mentality. Just because everyone on social media or TV is suddenly talking about a particular hot stock doesn't mean you should jump in. Usually, by the time it's common knowledge, the smart money has already made its move, and you might be buying near the top. That's how beginners become the harvestable leaks.
Don't be a leak. Got it. And those hot tips?
Treat them with extreme caution. Tips from friends, family, random people online, supposed insiders. Most of the time, that information is unreliable, old news, or maybe even deliberately planted to manipulate the price. You have to base your decisions on your own research and analysis matched to your own risk tolerance. Don't trade based on someone else's rumor.
Do your own homework. Don't follow the herd or whispers. Related to this idea of not reacting impulsively, the guide talks about cultivating a long-term perspective and avoiding overtrading.
Yes. This is crucial for mindset. Real investing, especially if you're looking at company fundamentals, value investing, takes time. Wealth isn't usually built overnight in the stock market. It compounds over years. If you come in expecting instant riches, you'll likely get impatient and make mistakes.
And trying to jump in and out all the time, overtrading.
That's usually a losing game for individuals. Trying to constantly time the market, buying and selling frequently to catch tiny wiggles in price, is incredibly difficult to do consistently well. Plus, every trade costs you money in commissions and fees, which really adds up and eats into any potential profits. Study after study shows that, on average, investors who trade less frequently tend to get better results. Patience pays off.
So how does a beginner actually build this kind of discipline and patience? How do they improve their mindset over time?
The guide's advice here is straightforward but effective. Keep learning and keep reflecting. The market is always changing, so stay humble, keep reading, keep learning about finance, economics, market trends, and use those demo accounts. Practice your strategies, test your ideas, get used to the mechanics without the emotional roller coaster of having real money on the line.
Practice without the financial pain, right?
Yeah.
Builds muscle memory without breaking the bank.
Exactly. And another really powerful tool the guide recommends is keeping a trade log, like a diary for your investments.
What do you put in it?
For every trade you make, even in the demo account, write down why you did it. What was your analysis? What were the market conditions? What was your plan? Stop loss, take profit. Then record the outcome, profit or loss. And most importantly, reflect. What lessons did you learn? Did you follow your plan? Did fear or greed creep in? Reviewing this log regularly helps you see your own patterns, your strengths, your weaknesses, and helps you refine your approach over time. It forces self-awareness.
That makes a lot of sense, learning from your own experience systematically. The final thought on mindset from the source really sums it up. Often, discipline and patience are actually more important than having the most complicated analytical model, especially when you're starting out. A long-term view helps filter out all the short-term noise that triggers those bad emotional reactions.
It really does. It acts like an anchor in stormy seas. And doing things like setting up regular automatic investments into a broad index ETF can also help build that discipline. It takes the emotional timing decisions out of it and forces a consistent long-term approach.
Okay, so we've covered a lot. We started with the basics, long versus short, and that huge difference in risk, especially the scary parts of shorting. And then we really dug into what the guide says is the essential groundwork for any beginner. Building that knowledge base, making smart choices about brokers and those first stocks, putting on that vital risk management seatbelt, and crucially, working on the mental game to handle the psychology of it all. The source definitely ends with that strong warning about short selling for beginners.
And it's worth saying one more time because it's so important. Yes, the idea of making money when prices fall sounds appealing, but the reality of short selling, the complexity, the costs, and especially that potential for unlimited loss and the nightmare of short squeezes, it just makes it fundamentally unsuitable and way too dangerous for someone just finding their feet in the market.
It needs a level of experience, capital buffer, and frankly, emotional steel that just takes years and years to develop. The guide's logic really holds up. Get good at the simpler, risk-capped long game first. Master that foundation.
Totally agree. And while there are other ways experienced traders might try to play downsides, like using options, those bring their own whole universe of complexity and risk, and are also generally not beginner territory without a lot of dedicated learning.
So the overwhelming message for beginners coming out of this material is focus. Focus entirely on understanding and mastering the fundamentals of going long, buying good assets you understand, hoping they appreciate over time while being incredibly diligent about building your knowledge, making careful choices, and having absolute ironclad risk management rules in place.
That's the path. That's what gives you the best shot at long-term success while protecting that crucial starting capital as you learn and gain confidence. It's a marathon, not a sprint.
Right. Okay, we've really taken this guide apart and pulled out, I think, the core wisdom for anyone starting out. Understanding long versus short is step one, yeah, but this deep dive really shows it's just the tip of the iceberg. There's so much more to getting prepared.
You absolutely need that solid foundation of knowing how markets work, smart ways to choose where you trade and what you trade. Those disciplined, baked-in risk management habits, that whole seatbelt system we talked about, and maybe the toughest part, developing the mental strength to keep your emotions in check and avoid those super common, very expensive mistakes that greed and fear cause.
The big takeaway we're getting from this source material is pretty powerful. Investing in stocks isn't like hitting the casino hoping for a lucky spin. It's supposed to be a disciplined process, a system. It requires planning, ongoing learning, and consistent practice over time.
Yeah, rational analysis should be your guide, helping you make informed choices. Strong risk control acts as your ballast, keeping your ship steady even when the market gets choppy. And maintaining a calm, disciplined mindset is like your sail. It helps you navigate through the inevitable storms without panicking or getting blown off course.
Well said. And as we wrap up this deep dive based on the beginner's guide, here's maybe a final thought for you, the listener, to chew on. Given that really fundamental difference, that asymmetry in risk we discussed, where going long caps your loss at your investment, but going short opens the door to theoretically unlimited loss. How does that profound imbalance inherently shape things? Not just the strategy you need to use, but the entire psychological makeup, the kind of mental fortitude you need to build and master to successfully navigate the market, especially when you're right at the beginning of that journey. Something to think about as you take those first, hopefully very educated steps.
It's a great question. That asymmetry really does impact everything the capital required, the stress levels, the type of discipline needed. It's fundamental.